So just a quick intro to myself and my firm. Jason Tedesco. I live here in St. Louis. I've been with my firm, Legg Mason, now for this June will be 17 years. So we're going to get into this presentation, which is titled "The Anatomy of a Recession." So the takeaway of this presentation I want everyone to get comfortable with is what's the noise in the market and what's the underlying signal, right? There's certainly a lot of noise to pay attention to out there, but is a truly underlying signal that we need to be worried about. We're going to define what a market crash is versus a pullback. We're going to talk about what a recession is. Just quick poll, does anyone actually know what the textbook definition of a recession is? We hear this word a lot, but what does it actually mean?
So many quarters of...
Two negative quarters of GDP growth. Bull and bear markets, we hear that termed around a lot. Does anyone know where the term bull and bear markets come from? I've been in the industry 20 years. I did not know this until Monday of this week. So the term bull and bear market actually comes from the way the animals strike. So if you think about the way a bull attacks with their horns, they kind of strike in an upward manner with their horns, and bears tend to stand tall and claw down. And that's where the history of the bull and bear market came from. And I did not know that until I sat through a presentation on Monday. So turning to page 3, this is a look back, just going back to 2015, so about 3 years, looking at what we define as sort of panic attacks in the market and the impact that it actually had on the S&P. So all these topics along the way have caused markets to move sharply in either directions, and basing portfolio decisions on panic attacks, history tells us, is a poor investment discipline. And this is what we're trying to address in this presentation, is what gets an investor comfortable with the noise versus the signal. Okay? So page 5, and Dan touched upon this a little bit. What is a market crash and what is a pullback? This is a little bit of a busy slide, but I'm going to try to simplify it as much as possible. There's really no textbook definition of what a market crash is. For us as an equity manager, our sort of in-house definition of what a market crash is a drawdown of the S&P 500 that's greater than 20% that lasts longer than 1 year. So a drawdown of 20% that lasts longer than 1 year. A pullback would be a sell-off in the market of, say, 15 to 20% that is typically short-lived. And the point that we're trying to make on this presentation, and Dan touched upon this on his intro, is market crashes tend to lead to a recession at a much higher probability than just your garden variety pullback in the market. So if we as an investor can identify what a market crash is versus a pullback and what recession actually looks like, we can hopefully protect portfolios on the downside. And hopefully through this presentation and some of the formulas that we think we've created in-house, we think we have a tool that can help investors identify when a potential recession might be coming. So we've had a very low growth, low inflation, slow recovery. We really haven't had that quote-unquote boom in the economy since 2008. So for us as an equity manager, it's hard for us to see a bust without that potential boom. The way the economist for ClearBridge who puts this together, he says the car has been driving at 20 miles an hour on the highway. It's really hard to get into a bad car wreck when you're driving 20 miles an hour. So, any questions on this slide at all? Because I think this is a very good illustration for where we are in the cycle, and that time is not the best determinant for this expansion ending. It's the magnitude of the recovery that matters more. Okay. Page 8 is a look at economic expansion. So right now we are in the second longest U.S. expansion in our country's history. If we make it to July of this summer without a recession, which we are confident that we will, this will now be the longest U.S. expansion in our country's history. So tight banking system, low unemployment, low wage growth, low inflation kind of keeps the porridge warm and running for a long period of time. And then Dan mentioned the dashboard, and I think that's really the bulk of the presentation, page 9. This is a proprietary piece of information that our strategists at ClearBridge have put together. They've looked at thousands of different input units, millions of different ways, and we've landed on these 12 items that we identify as great leading economic indicators for what the overall economy looks like and what the health of our markets are. So these economic indicators are broken into 4 categories, the financial system being the Fed, inflation, the consumer, and business activity. We use a stoplight analogy for reporting purposes, so green is good, yellow is caution, red is recession. We try to keep the reporting of this very simplistic in nature. What goes on underneath the chassis of each one of those input units is extremely detailed. There's a lot of moving parts. We update this constantly throughout the month. And for us, this just kind of gives us an overall temperature of the economy. So if you take a quick look down the dashboard right now, we don't see any recessionary indicators. The dashboard is still mostly green. There is a little bit of yellow that has come onto the dashboard, but most of the yellow is centered around the financial markets and the Fed. And if you are a follower of the Fed and financial markets, to us, this is not a surprise with what happened last year with the Fed raising interest rates and unwinding the balance sheet. They changed their positioning a lot in December, so we could actually see some of these numbers reverse. But the most important part is kind of that green bar on the bottom, the overall signal on the dashboard, right? This is the current situation right now. This is by no means meant to be a crystal ball. We built this tool to sort of give us a look out of the next 12 to 18 months. That's it. Anything outside of 18 months is very, very hard to handicap. There's an enormous amount of things that can go on. But for us, we feel we can get a good gauge on the next 12 to 18 months. And we think these are the best indicators for basically predicting a potential recession in a country. Okay? They're not equally weighted. We get that question a lot. The consumer, you can see, has more categories than others. The consumer represents about 70% of our economy, so they're very important. But each one of these are not equally weighted. So the question says, has it been successful? So if you turn to page 10, we went back and basically categorized every previous recession. So all those time frames across the top, you have the current environment as of the end of the fourth quarter of 18, and then all those time frames across the top, 2007 to 2009, 01, 1980, those are the previous recessions that we've seen in modern times in this country. And what we're illustrating here is what this dashboard looks like during a recession and what it looks like during the current environment. And the takeaway is, when you're in a recession, you have an enormous amount of red, a little bit of yellow, and potentially some green. And if you look at it relative to our environment right now, our overall signal is still green, and we don't even have a single recessionary indicator in the dashboard right now.
So I guess this would be even more interesting if your chart was the dashboard 6 months before each of these recessions.
It's a great question.
'Cause
Turn to page 11. We've heard that before. So page 11, we illustrate that for you. So we go back to the 08, 09 crisis, because it's the most fresh in everyone's mind. And what we're showing here is using those same inputs and all the same data from Q2 of 06 all the way through to Q2 of 08, how this dashboard would have shifted and changed. So in Q2 of 06, our overall signal on the dashboard was still green. You do have 2 recessionary indicators on the dashboard, but the overall signal was still green. Some point Q1 of 07 to Q2 of 07, the overall signal shifted to cautionary. And by Q1 of 08, the overall signal was recession. The chart on top is a look at the S&P over the same exact time frame. So your S&P peaked in October of 07, I believe it was, and your recession started somewhere around the early part of Q1 of 2008, late 2007. So all of this now is fully public, so you can go to Google and just type in ClearBridge, the anatomy of a recession. It's a public website. This is public information. You can register yourself to receive these updates quarterly if you like, but all this information is now public on the website. If you were reviewing this data, 06, 07, 08, you might have started to look at portfolio construction at some point at the end of 2007 a little bit differently.